Hello, welcome again. Now we move to our lesson 3 of our series of property, plant and equipment under IPSAS 45. Welcome back again. So in this third lesson, we are going to build a strong foundation by defining the key terms you will encounter again and again. Understanding this language is crucial for applying the standard correctly. So let us get started. We will start by defining what carrying amount is. What carrying amount is. Sorry. So carrying amount and class of PPE, that's what we'll start with. So when you hear carrying amount is just the NBV. The NBV, this is the value, the book value. You start with the original cost and then you subtract any depreciation and any impairment losses it has accumulated. For example, if a government agency bought a vehicle for 3 million shillings and it has an accumulated depreciation of say 1 million, then its carrying amount is now 2 million. That is same as NBOK, NBV or net book value. Next, we look at class of PPE. Class of PPE. This is a group of similar assets and they are brought together when reporting. For example, a class of motor vehicles, a class of office building, class of ICT equipment. They are organized in a way it's easy to understand. Remember the concept of aggregation and disaggregation. We move to depreciation and depreciable amount. What is this depreciation? Depreciation is as a result of wear and tear. That's what you know. Is the process of spreading an asset cost over its useful life. And we know the reason because of wear and tear. So over its useful life or service potential. So if it is 10 years, then we spread the cost to 10 years, 5 years, etc. The annual depreciation might be say 500,000 and the vehicle cost is 5 million. So the useful life of that asset is 10 years. So when we talk about depreciable amount, what does it mean? Depreciable amount. It means if you take the cost of that asset and you subtract or minus the value or the residual value, the amount that will remain, then what do you get? You get the depreciable amount, the amount that can be depreciated. Because at the end of the day, the residual value will always remain. The residual value will always remain. So, what is residual value? Is the amount that will always remains. I call it the scrap value of that asset. The scrap value of that asset. So next, we look at residual value versus useful life. Residual value versus useful life. Remember, in our previous, we mentioned residual value. It is the estimated amount an entity expects to get from disposing an asset after the useful life is over. The scrap value, the resale value. If an old grader might be sold for parts, say, the sale price will be, or when you sell that scrap is the residual value. The useful life is the estimated time or the expected time that asset will be available for use. For example, a new laptop in a government office might have a useful life of say 3 years before it's considered to be too slow or obsolete. Next, we move to historical cost versus current operational value. When you talk about historical cost, it is the cost you purchased for that asset, the amount you paid. So it is the original price, all the price of that asset, which includes the purchase price and any cost directly related to getting it ready for use, like delivery, site preparation, and installation fees. Then there is this newer concept, current operational value. How is it different from this? This is not what we used to call the market value. Instead, it is the cost you will pay today to get the same level of service potential your current aging asset still provides. For example, how is it different from market value? You go back to the market. If it is a school, for example, school buildings or classes, you go back to the market and measure how much you can build such a classroom, or you can get it from the market. If you know, for example, you can build it for 50 million, then and you have used that asset for 20 years, you depreciate up to 20 years. You take the 50 million and depreciate for 20 years, and you depreciate for 20 years, and that is what we call current operational value. And finally, we explain the fair value and deemed cost. Fair value and deemed cost. What do they mean? Fair value is simply the market price. So it is straightforward. It is the price you will get if you sold the asset in a normal transaction today. For example, the fair value of a government-owned building is what a buyer will be willing to pay for it in the open market. What about deemed cost? In simple terms, we say is the substitute cost for historical cost. It is often used when an asset is acquired for free, like through donation, or when you are moving from cash basis to accrual. If the cost for that asset is not available, then you apply the substitute cost, which can be current operational value, or it can also be the market value. So that is the end of our lesson 3 today, where we were defining the key terms used under this IPSAS 45. Thank you for your for listening, and thank you for your time. Let us meet again as we continue with this series when we are tackling class or lesson 4. Thank you and enjoy your day.